maybe. Altin, would you like to go first?
Sure. So, good morning, everyone. Thank you for the invitation. Yes, my name is Altin Kadareja. I'm the CEO of Cardo AI. What we do is that we aggregate different digital alternative investments and provide this access opportunity to institutional investors, which could be pension funds, asset managers, or banks. Why we came up with this idea? Because we started to invest our own money and we saw that actually standardizing, normalizing, and having a transparent software that provides you the possibility to choose these digital lending assets, it's missing out there. So there was no software available in the market that could somehow aggregate and provide the opportunity to invest immediately, for example, 50 to 60 million euros instead of only 1 or 2 millions that could provide every single originator. So think about this new digital asset class that were born after the financial crisis. And what we do is basically that we onboard all the assets, then we standardize and normalize the data to do mainly three things: to measure risk, measure performance, and provide the opportunity to create portfolios. So then you can report and monitor on your own terms. It has been good so far. I mean, it's quite young because we developed the technology in the last 1.5 years, but we have already one big investor out of the UK, which is using our platform daily. And yes, I mean, we find lots of value in the technology, and hopefully we can support some new originators coming into this market with some new funding, if there is anybody in the crowd.
Great, thank you. Felicia?
Hi, I'm Felicia, CEO of Akoni. At Akoni, we provide a cash marketplace, very simple. We maximize returns on an underutilized assets within a specific risk framework. We work with wealth platforms, the wealth sector, quite extensively, and we provide a utility like electricity. Your cash should be working with you. And we also work with banks, providing a white label solution for their clients, including SMEs. We are what we call B2B to X. We are a specialist sector and business player. We consider technology as obviously key to everything, but more than technology for us is the openness of data utilized with that technology. And we're seeing that massive change sweep across the world as governments seek to make all of their data far more digital and everything available via APIs.
Excellent.
I'll take it away.
Yeah.
So Drew Sterrett, CEO of Lex. What we've done is create the first commercial real estate securities marketplace, where my background's in real estate private equity. I was looking to structure these deals, seeing the money that could be made, was being made, and then really under a fundamental premise of frustration and wanting access, asked myself and then asked the rest of the team, how do we not have the oldest and largest asset class in the world and have any liquidity and transparent marketplace for it? So what we've done is created a new product where we do equity recapitalization in individual and institutional commercial real estate assets that plugs directly into the financial institution to allow both accredited and non-accredited investors to wealth advisors, RAs, hedge funds, pension funds, institutions to invest alongside each other.
Okay, great. Well, thanks everyone. Why don't we, let's start off kind of drilling down on technology, and then we'll kind of broaden up the conversation. And I think specifically, can you each talk about the enabling technologies of your business and how perhaps these technologies open up opportunities today that you did not see 5 years ago?
Well, from Lex's perspective, one of the amazing things that we were able to do was automate the regulatory filings that we do on an initial basis and on a go-forward basis. So the nice thing about a commercial real estate asset in one location versus another location is just different sponsorship, the different tenants, and then I'm from the United States, so if you have an asset in California compared to New York, you have earthquake insurance disclosure. So that's able to cut out 95% of the underwriting costs and also the filing costs, and then do it on a much more quick basis.
From our perspective, it's definitely APIs. So it's not only the technology that we use, but what we ingest from various other providers. Obviously, we use open banking, but we think that the world is moving quite quickly far beyond open banking to what we call open data. And for us, this is what creates the personalization opportunity so that you as a financial institution or a channel partner can offer a particular product to your client that's relevant at their stage in their life cycle, whether they're a business or an individual. And it's that change that we see as generating more income for some of our clients, both not on the net interest margin side, as well as on the payment space, through a range of other tools that we offer.
So APIs as kind of a sort of a platform-basing mechanism to kind of link investors and link different platforms.
Yeah, in particular open APIs, but I don't know whether anyone here is familiar with the ODI's data spectrum, which goes all the way from, open data to closed data. So, open, everyone can see it, your Twitter feed, to closed data like private contracts. And actually there's various ways that you can ingest those different types of data, even if they are not yet available via APIs. But we see a massive move across markets where almost all data will be digitized. I don't know in the States, but in the UK about a year ago, the Land Registry opened their APIs. And you think, oh, so what? But that makes a huge difference. It doesn't take 2 weeks or 2 months for a title deed to move. It will be instantaneous at some point when the payment is exchanged. And even in the UK, the Bank of England is consulting on something called atomic settlement, where at the moment of any payment being moved, the underlying asset will be exchanged. And that for us in turn creates much more opportunity for the liquidity around near real-time or real-time investment solutions, which you then have to deliver with your relevant financial institution partners.
Okay.
So it's not just the data.
Great. Altin?
Yeah, so APIs have been the same relevant technology for us as well, because as you can imagine, being an aggregator, we have to be real-time reporting and real-time sending trading orders to different originators. So APIs have been the biggest change on the technology. But I would say even the new ways of writing software. So, for example, the microservice architecture for us has been a key point, because we can somehow customize and module the different software that we provide to different clients, which, for example, one can have 2 or 3 modules, the other one can have 15, and so on. So we can plug and play any module we want with the flexibility of a click. And then I would say even, for example, the front-end technology, I don't want to get too technical, but the new JavaScript React.js, for example, has been very useful for us to calculate in real time very quickly lots of data and to make it faster for the usability of the technology. So I would say both the ways that we interact with external softwares and the way we developed our own have been changing in the last 2 years. So very, very quick shifts and new technologies have empowered our solution, I would say.
Okay, great. Well, I think as every entrepreneur knows, technology is never enough. You can only get so far, and I think when we talk about asset markets and trading and creating marketplaces, you can have this great playbook, you can have this great technology, but again, going back to the liquidity point, if you don't have the liquidity, it's not going to work. And so let's talk about kind of the enabling mechanisms outside of technology to building your marketplace. And I think by that I mean partners. And when I talk about partners, I don't mean vendors, I don't mean infrastructure partners, I mean commercial partners that can drive volume and drive use and acceptance. So I'd love to hear your perspective on that, some of the challenges, the opportunities, the traction, and kind of how you go about approaching it.
Well, I almost want to answer this with
So
you.
many stories.
No, I almost want to answer this with you, given the conversation we had earlier, where we deal with integrating with large financial institutions, but the onboarding rate can be anywhere from 6 months to up to, as you were saying, 3 years.
In some cases.
And so it's one of the balancing acts where you have to understand what your lead time is to integrate with these partners, but also fundamentally, from my perspective, the real way you have liquidity is by bringing everyone to the table and allowing everyone to have access. So this is also targeting the 95% who haven't had access to these types of products or had the ability to ever even think about participating in these assets as well. But they are the ones, by bringing more people to the table and by having more transparency, you're able to fundamentally build true liquidity and have fair markets.
Can you maybe give us an example of kind of how that value proposition works? I mean, because you can imagine there are probably a lot of people on the sidelines who either have their own little market and it's very high margin and it's very bespoke.
Yeah.
And like, well, why would I want to do this? I mean, so how does that work?
Transparency.
Well, no, so the whole idea is transparency, and actually, I know this is also cliche, but it's the whole idea of the Uber model, like UberX, where they did high volume low transaction costs. So it's not the whole idea of you're buying a private jet or you're using Blade, taking helicopters all over the place. This was fixing an industry that needed to be fixed, but was already in existence. We still had taxis. Lyft actually technically came first. They then created Black Car, and then they created UberX for the masses. And that is actually what allowed them to gain traction and take those lower margins. So instead of making $5, $10, $15 each trip, they were taking small cuts along the way, but it was enabling them to open up to the entire market. And also we see that in financial services right now. We have fee compression across the board where people are actually, if they're gonna make an investment, I mean, back in the 90s, if you were going into a private REIT, your fee load could be up to 10%. So for every $10 you put in, you were only getting $9 of the investment. So by having this transparency, by decreasing the fees, and by opening it up to everyone, that is truly how you create liquidity.
Okay.
My opinion.
Yeah, I mean, in our case as well, it's just that sometimes you need to trade off to like manage correctly the trade-off between, because especially in Europe, we see the alternative lending market as a very small market. So we're not talking about the direct lending market, but digital lending market, which is not more than 10, 15 billion. So it's really, really small compared to the other markets, even in the US or in China. So sometimes you see lots of jealousy there by the big players, which want to somehow protect this asset they have on the market. So I would say finding the correct equilibrium between not captivating your offering to the market and somehow opening up even to other clients in order to bring more liquidity to the market is the right thing, but it's not easy to do, at least on our case.
So is that with the sort of I mean, how do you go about doing that? Is it on the sell side or the buy side? I mean, kind of like what's your entry point and how do you kind of get that scale?
Yeah, so what we saw as beneficial to us, being very quick in the market, was to get to the buy side first, which had the biggest problem of all. So through the buy side, we go to the sell side, and then we open up the market of the sell side with other buy side.
If, from our side, we partner with a number of banks. And for us, what's key is obviously our conduct in terms of the regulatory term of conduct, as well as our regulatory status is quite critical to getting our banks on board. And the bigger the banking partner that we partner with, the longer the time frame for onboarding. So literally we have small financial institution partners who our record was 8 weeks. And the longest was about, I guess, 21 months, and one which is already taking longer than that. So it's being able for us to navigate a long due diligence process, a long sales cycle, and then obviously persuading a large institution, because the number one priority that all our financial institutions have is, will you as a startup be here in a few years? Like we're offering products which are, span from an instant access all the way to multi-year products. And they want to understand what's the risk of us as a business not being around, what's the protection for the underlying clients. So we have a lot of legal protections in place as well as regulatory protection and all sorts of mechanisms that persuade our large partners who use us. So on both sides, the liquidity side as well as our client side. And I just want to pick up on a point that really we feel that 90% of the market is entirely missing out on, what, if you were a corporate firm with a treasurer has, most of the market does not have the ability to move things because of that friction and lack of transparency. And that for us is really where we see the solutions, now, in particular in the wealth piece.
So Felicia, I don't want to say it's easier or more difficult, but so your kind of platform is a little bit different than the other two on the panel. So you're working kind of more rather than, I guess you don't really have the competitive issue with your customers in the marketplace. Like you're not trying to disintermediate them. You're trying to provide services. Is that
and
correct?
Liquidity, yes.
And liquidity.
Yeah,
Okay.
yeah.
So do you find that easier or more difficult in terms
It depends on the institution. So the bigger the institution, the less transparency they like, bizarrely, around their products, especially in the commercial banking space. And the smaller, the more they need liquidity. So the more likely they are to work with in some sort of intermediary. And what I was saying earlier is a lot of the smaller banks, they use us to test elasticity of demand. So actually, if they deliver solutions via our platform or via our channel partners, like in the wealth sector, via a wealth platform or a wealth manager, and then they change their rates, because they can change their rate on our platform and not in public, what is the change in demand? And that comes back all to that utility that's delivered by these type of solutions. And for us, one of the biggest things is the cost of onboarding a client for anti-money laundering. So although we haven't discussed that specifically, that technology is also contributing to decreasing our customer acquisition cost, which we then provide to a wide range of financial institutions.
Okay, great. So we've covered technology, we've covered partners. Now the third rail, regulatory. So I think, again, each of you in a different space, different sort of ecosystem. You're partnering with different customers and partners in the space in terms of different providers. So how do you think about that regulatory dynamic? I mean, obviously, the closer you get to the retail investor, the brighter that light shines. The more bespoke and institutional, perhaps less scrutiny. Has the regulatory issue been an enabler or an impediment or a partner?
Since I deal with this on an everyday basis, so the two government agencies that we've worked very closely with is the Securities and Exchange Commission, the SEC, and then also FINRA. And we take the approach, which was not the lending club approach, which is just break it and try and fix it later. We truly look to dot every single one of our I's, cross every single one of our T's, and just make sure we are in their best graces, because they're fundamentally here to help us and also to protect consumers. So by working closely with them, we can create the best product for everyone across the board, and then at the same time, it actually builds a competitive moat, because the whole idea, and sort of what we were going back to before, is the banks and the financial institutions need trust, and so the same regulators also need the trust that you are going to take your best actions and also follow the letter of the law. And if you have questions, they're open to having discussions with you, since they're always evolving and they understand that the landscape is changing, but I view them as a great value add.
So, clearly, there's a halo effect to sort of having that engagement and having that quote-unquote acceptance, but there's also, it's a foggy road. It's not necessarily clear what's expected, particularly in new asset classes, and when you're dealing, with expanding these marketplaces. So how do you navigate that challenge?
It really is a dialogue, since you have to remember, they're going through a learning process as well, since they have so many new products come across their plate. And actually, especially in the administrations that we're working with right now, they are looking forward and actually trying to address, the chairman, Jay Clayton, terms it Mr. and Mrs. 401k.
Yep.
So basically trying to actually enable the average day investor. So I do think they actually have the right heart, and that they're looking to grow as well. So they also admit that they don't always have the right answers immediately. So they're like, let us check it out and let us work with you to make sure that this is almost a team collaboration. It's not just, it's not like bad guy versus good guy, it's coming together.
A very diplomatic answer, Drew. Go ahead, Felicia.
From our perspective, regulation is very important, but actually most of our institutions who we deal with, it's a given that you must be regulated in what we do. And actually, there's much more detail around the proposition work, which focuses on how they deliver it through their set of regulation. So because of that, on our board, our general counsel, for instance, is a wealth specialist, which understands, if you know the UK market, I'm sure Europe and the US have similar rules and regulations around pension products, investment products, tax wrap products, which have very specific set of regulations. So when you deliver those to the end customer, you have to understand exactly what the regulatory regime is. We are not regulated to deliver investment products, but because we deliver our solution via an API through a company that is, our entire proposition has to go through that structure. So in a way, the conduct framework is set up for large financial institutions to create this additional regulatory moat, in addition to the regulator. So, yeah.
Okay.
Yeah, so the same for us. I'm just not going to add any more on what Felicia was saying, just taking another angle. Given that the digital alternative asset space has been a bit unregulated in the beginning, now for us, the intervention of regulatory regime of FCA has somehow supported the increased investment from the institutional investor space, because they came out with a with 30, with a minimum percentage available to the retail investors, opening up new opportunities for the institutional investors. So for us, it has been very good because it opened up new demand. And whatever Felicia was saying, we do the same thing. So.
So I think a more general question is, and this is sort of something that's fundamental to the investing side where I come from, but also fundamental to the capital markets side. When you think about a tipping point in your business, and I think particularly when we talk about capital markets, asset management, and traction and volume and liquidity on a platform, it's it's sort of like this. You're kind of like this, and then boom. So let's talk about that tipping point. Presuming none of you have hit that yet, what's it going to look like? What are the prerequisites to get there? And, where are you on that journey in terms of achieving that?
So for Cardo, we are just at the beginning. So we are building the infrastructure and the technology with the time going. So we suppose, at least in our business plan, we have that point in 2 years period of time. This is where we believe that we have been very lucky with the low interest rate regime now, because every institutional investor out there is looking for new high-yielding alternatives, and digital lending asset space looks very interesting to them. So we believe that if these macroeconomic indicators look forward and go forward in this shape, it will be for us in the next 1 year and a half, 2 years, where we have the volumes under management, respecting, let's say, the robustness of the technology. And that's where we can somehow scale very fast, and then we can get the tipping point. And as well as, of course, the acceleration on increasing the market reach in Asia and in the States.
So you feel that driver for you is going to be low interest rates attracting users to the platform?
Absolutely. The more demand there is on the buy side, the better it is for our technology. And the more demand it is for these kind of products, then the more supply it will be from the digital originators, which will see this kind of liquidity gap, I would say, and then they will try to fill it somehow.
So the network effect.
Absolutely.
Okay.
From our side, likely over the next 2 to 3 years, we're still early stage, and while we have quite a significant amount of cash on our platform, we think that the delivery will be via other ecosystem players in terms of the scale and the tipping point. And for us, the wealth sector, which obviously I guess this panel is focused on, is quite significant in that respect because of the network effects and massive competitive pressures. In our home market on the UK side, the top part is controlled by very few players. There's only 35 platforms in the UK which control trillions in assets and are delivering solutions. And the big daddy of direct investment, Hargreaves, launched a cash solution. So there's this massive push to come out with something or have your market share eroded. And we think that adoption process will take a year, with another year to actually roll out the proposition where the market starts adapting to it at scale. We think that the business sector, especially the SME market, is going to follow. It's a much more immature sector in terms of the nature of near real-time type of investment decisions, lack of advice, lack of a strong incentive structure. But because of the tools, again, we see that's going to change.
And so I guess drilling down a little bit, Felicia,
Yeah.
I think you have a different challenge than the other two panelists in the sense that you have got sort of longer sales cycles into customers. And so is the goal to kind of target a handful or to go for kind of small to medium-sized customers and kind of build out from there, or take a slice of large customers and then get more volume through that? How do you look at that kind of gelling over the next couple of years?
So in the ideal world, we would start with the big daddies, who are the software providers to the platforms, but they also have very long sales cycles. So our aim is to provide the solutions roll out via a number of the platforms, some of which are small, one of which is probably the largest in the UK. And for them, they also need pressure points from their clients who are wealth managers and advisors. So what we look is the framework across that sector. It's a massively competitive pressure. It's almost like a boiling sector, and once one rolls out, they all seek to have a solution as rapidly as possible. we're one of the few solutions that has we have zero competition. We do not onboard direct end consumers like individuals, like ourselves sitting in the room at all. So we're fully API enabled in everything we do. So being able to create that profile, and we also see that the big financial institutions which are not transparent now are starting to look at solutions where they can curate very selected partners. So they offer their own products via certain of their own platforms and then select 2 or 3 non-competing financial institutions. And that also, we think will probably be over the next 3 to 5 years starting to come, because we already in discussions with a few, tentative, you can see they're stepping tentatively in that direction.
Okay, great, thank you. And Drew, you have the last word.
Yeah, I mean, always still have a long way to go, and there's always room for creating a better product. For us, it's sort of twofold. One is the continued integration with these financial partners that do control so much of the wealth, and also just the ability to access it. But at the same time, it's also an educational process for the everyday investor, since they're also the ones that drive their wealth advisors to then say, hey, I want access to this, I want to have this product on platform and be custodied here. But it really is, for us, an educational experience on both the retail and the institutional side, since it's bringing an asset class that has existed just in a brand new securities market. So just teaching people sort of the ins and outs and how it can best benefit them and their clients.
And what do you think is going to take longer? Is it going to be the retail or the institutional? I mean, I guess, is it, I mean, institutional is obviously chunkier. Retail can obviously have more staying power, I guess.
Yeah, I actually do see it going side by side.
Okay.
Since when banks are truly motivated and sort of the platforms see the true value created immediately, sort of at the end of the day, we're also dealing with 2 of the oldest asset classes in the world. We're dealing with financial institutions, and then we're dealing with commercial real estate. Yeah. I like to joke we had artificial intelligence funds before we had any property technology funds in the first place. So they're very, very slow monsters that we're dealing with. But at the end of the day, if you can bring them to the table, you are able to create something amazing together.
Great. Well, thank you very much, everybody, and good luck.
Thank you so much for having us.